Hello, credit union executives. Welcome to See You on the Show, where we give you up-to-date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. Today on the show, we have Jay Rogers returning from the Stearns Group to talk about the strategy that we discussed last time. Now, the strategy that Jay and I discussed was this new innovation that Stearns has developed that allows credit union leaders that have CUOLI or collateral assignment split dollar options that have never been seen before. So with the reaction we got from the first episode, we decided to open up a second episode and really focus on use cases for this innovation. And with that, Jay, you want to go ahead and introduce Eric?
Yeah, certainly. So thanks for having us back on, Doug. We're excited to be here. I thought it would be really valuable for your listeners to not just hear my take on this, or even just Eric's take on what we've built, but to be able to kind of grasp some of the actual cases that have already gone through and moved in with this. So what we've seen from the, as you touched on, the CUOLI side, from the collateral assignment split dollar side, we have been working with many credit unions already at what we'll refer to for this episode as the LifeNotes Strategy. And we're going to go over a few of those cases today. And Eric Stearns, who is the principal of Stearns Financial Group and really the brains behind the LifeNotes Strategy, is going to go deeper into some of these case studies that we'll see on and how they've added value to these credit unions. So I think that's the best use of our time here today. Eric, would you like to jump right in?
Yeah, thanks, Jay. I certainly will. So I know a lot of you out there listening, and as you might recall, I often joke that my knowledge set is a foot wide and a mile deep. Part of having that mile deep philosophy is that we took a very deep dive into how these programs work, specifically split dollar, life and credit union and life insurance, investments in general that we work with our clients. And at a very high level, really what we're talking about and what the trade-off is, the relative trade-off between priorities at the credit union, all come down to time versus money. And that's something that's going to be very familiar. You know, if you're sitting in the CFO role or the CEO role, you're thinking about the relative trade-off that you're making inside your portfolio from an ALM perspective on mortgages, business member loans, car loans, credit cards, other kinds of investments that you may be making in order to generate portfolio that's going to have the outcome you're trying to achieve. And we do the same thing when we look at split dollar and credit union owned life insurance, when we're looking at an investment amount and duration trade-offs for every dollar of benefit being created. So we're trying to create this optimization from a financial standpoint. And I'm going to say that once we go through the exercise of understanding what the benefit should be and how it can be used strategically at the organization, it then really turns into this optimization problem. And that's how we approached this when we started really in earnest developing this about 2 years ago. And really over the last year, all of these things started coming together, and it started coming together at a very appropriate time given the changes in the interest rates and markets and so forth, because what we've come up with creates a set of tools. It's a set of tools that we can then use as professionals in the deferred comp space to create the type of retention and incentive packages that are really needed for retaining talent at your credit union, whether it's the CEO or the CFO or other senior management. Doing that in a way that's going to be more financially advantageous for the credit union and produce for the executive that has the plan, the participant in the plan, exactly what they need, and do it in a way that's going to be more secure. So we created this, what we'll call a secured LifeNotes strategy. And some of the goals that we went in with, and really part of the reason for doing this was that we as we take on plans that maybe other, what do I call, independent agents, maybe a local agent had put together for a credit union, and as a national organization, we work with hundreds of these across the country, so we would often pick up a plan here or there. And those plans, what we found was that they were really not going to produce what was originally intended. And they weren't going to produce that because of some of the factors that we've seen over the last 5, 10, even 20 years in a decreasing interest rate environment that's impacted dividend rates at insurance companies, crediting rates on the IUL products, and really put some people in not the best position, because all of a sudden you've got a plan that you really were expecting to have happen. Things were expected to work out, and they're not really occurring. So that's really what drove us into this, to say, how can we solve this in a way that's really going to make sense for everybody? The spin-off of that was this tool set that allows us to do a whole bunch of things. And that's why it was the questions that came out of the first podcast really led to the idea that, well, we should share some of the ways that we've used this tool set that we've created on a case-by-case basis.
Yeah, and I think in our pre-discussion, my understanding was it seems like the CUOLI space is the easiest one to explain, with the interest rate change that we've seen when rates are much higher than they were a few years ago. A CUOLI might be the easiest one for our listeners to be able to just immediately grasp. So can you give us some examples of that, Eric?
Absolutely, yeah. So the interesting thing with CUOLI is that as interest rates decrease, the rate of change of the interest rates is slower at an insurance company than it is in the market in general. In other words, there's a lag effect. 1 to 2 year lag is what we see statistically. What that really means, where the rubber meets the road, is when you're comparing an investment that's earning, maybe you're a mortgage getting 1% net or 2% net, which is where the position we were in a few years ago, or even 6 months ago. It's been a crazy year. But comparing that to a credit union owned life insurance program that might be netting 2.5, close to 3%. And that looks pretty good. But if you reverse that picture, as the interest rates start to rise, that lag effect still occurs, which means you're still going to have a 2 or 3% return, while now you're getting 5 or 6% in the mortgage. So in a rising interest rate environment, it looks less attractive. Now, there's a very strong case for looking at the long-term picture, which, if we do look at that long-term picture, 10, 15-year time frame instead of 1, 2, 3-year time frame, it begs the question, how do we maximize what you're really going to get out of this credit union-owned life insurance program? And for an example, I want to give you an example of a credit union that we worked with. They're $100 million in assets. So, a growing credit union, but on the smaller side of credit unions in general. They had a net worth of $10 million, and they had $6 million invested into one life insurance policy. And that life insurance policy was netting them about 4.5% to 5%. It's the insurance company backing that policy is New York Life. So it's a very, they're by almost every measure the most secure life insurance company in the United States. So there was little actual concern about, the solvency of New York Life. However, regulators were still very keen on the idea that you shouldn't have more than 15% of net worth in any one insurance carrier, and with that guideline, 25% of net worth in normally impermissible investments. They wanted the credit union to actively dial back that investment. Now, that was pre-COVID. Of course, the world changed a lot once COVID hit, and what we saw was that there was a little more leeway in that, because that was still a 5% asset in a time where we had 0% interest rates. So now that we've kind of come full circle, we start to see pressure on the, how do we manage the compliance aspect of that? What we were able to do is take this program and put it into our LifeNotes strategy. And the result of that was that the credit union is now earning SOFR 30 plus 360 basis points. So that's the 30-day moving average of the Secure Overnight Fund rate that's published by the New York Fed, plus 3.6%. So they're getting currently APY of 6.29% in the current month. The nice part is that floats. It's going to be a very ALM-friendly rate. as interest rates go up, as interest rates go down, it's going to be very sensitive. But because it's that addition of 3.6%, it's not going to go below that. So it has a floor, just like your life insurance, because it still is life insurance backing this program, the strategy. And the life insurance has a guaranteed rate of return underneath of it. So what we were able to accomplish with that, with this strategy, is that now they're at 15% of net worth backed by life insurance assets, and the remaining portion is now a permissible asset of the credit union. Their weighted average return is just over 5%, which means that they were able to maintain that high yield that they wanted to maintain while getting into compliance. This strategy and some of the flexibility that it allows is that percentage of net worth versus of 701(19) were normally impermissible investments tied to employee benefits versus 703(14) investments or permissible investments is dynamically allocated. So as their net worth changes, we can immediately adjust that. And that allows them to have, it allows, especially a $100 million credit union, CFO is wearing a lot of hats. And, at a larger credit union, you might have a full department dedicated to optimizing that formula. Well, here, it's hitting the easy button. It allows them to optimize that percentage of net worth, take as much advantage of it as possible, and remain in compliance.
Very interesting. So with the use of the LifeNotes strategy, you achieve two objectives. You increase your return on the asset, and you optimized the type of asset in your net worth structure. The other thing I wanted to understand is credit unions that have existing relationships with executive benefits specialists, with agents, with various professionals, they don't have to just leave them behind and sign up with you guys, right? They can somehow work together?
Yeah, absolutely. So this is a strategy that allows us to keep the assets in force and in place. In fact, it relies on this idea that we need to keep the life insurance in force in order to maximize how much value is coming out of the program. I like to say we created a really nice mousetrap, but it's a mousetrap that everyone can take advantage of. It's something that we created a product that we saw that was needed in the marketplace, so we could use it as Stearns Financial Group. But LifeNotes, it exists independently, and we have partnered with many other organizations that do similar or very similar or even the same things that we do as Stearns Financial Group to allow them to have these tools available as well. Because as you'll see in a couple of cases that we'll talk about, this has a broad ranging applicability to fixing in-force plans, also to shortening duration or increasing yield in a lot of other scenarios. As I said, it was kind of born of the idea that we needed to take action on some of these programs that weren't going to necessarily produce what everyone thought they were.
That's a really important point, because these relationships are powerful, multi-year relationships, and knowing that a credit union doesn't have to break that relationship in order to gain this flexibility, I think is an important detail. So option one was under CUOLI. This use case is where a credit union is looking to increase their yield and optimize the type of asset that is in their net worth. So it dynamically optimizes the type of asset and increases the yield. So that's an easy first use case. What's your second one under CUOLI?
Sure. So the second one under CUOLI, I'm going to kind of combine a couple of ideas into it and look at it as a CFO who is looking to increase or add to their portfolio, increase their portfolio or add to the yield in the portfolio. The use case here is actually a multi-billion-dollar credit union, and they have just under $100 million of credit union-owned life insurance. So they've made some significant investments already, and they're looking to add a little bit more, but they've realized what all of the listeners may have realized, which is life insurance as CUOLI ends up being a little less liquid than you really like to think, because there are some strategic risks involved. Once you have somebody go through underwriting, you may have some life insurance spin-off benefit to them. And if you ever wanted to liquidate that for the cash value, that means that that person's not going to have that benefit anymore. So there's some tie that gets created in these that is to an employee benefit, as it needs to be for a permissible or normally impermissible investment, but it creates stickiness that doesn't lend itself to liquidity. Additionally, you've got the kind of lag of the returns. We're seeing in this particular portfolio, they had a lot of what I call a combination product that used a annuity rider in addition to a little bit of life insurance, which adds some stability to it, a life insurance program, but it also means you're not taking advantage of full life insurance returns. You're only getting a net 1.5. I think they were getting 1.9% return on that portion of their portfolio. So we can do a lot better while taking less overall risk. If it's a optimization problem from a finance standpoint, you're looking to take as little risk as possible and getting as much return for that risk that you're taking as possible. And here they're not being compensated for that. So this is something where we went in and were able to add this portfolio to the strategy. And this strategy kept those assets in force and used them in a different way. And by doing that, by essentially breaking the cycle that we get into as credit unions, where why is the credit union going into a 2% annuity based life insurance program? Well, the biggest reason we come up with is that all your friends are doing it. Just because all of the credit unions, everybody else has done it, so must be a good thing. Well, not necessarily. There's a better way to approach things that allow us to break the cycle or to expand the cycle of the binary relationship that exists between a credit union and the insurance company. And by leveraging our expertise in this area, we can increase the return. So here, where the rubber meets the road, again, where it really matters, we were able to take the portion of the portfolio that we were working with, take it from a net yield of just over 2%, turn it into that before mentioned SOFR 30 plus 360. In other words, a current net yield of 6%. So it almost immediately tripled their monthly income. And we were able to keep the life insurance portion that was assigned to those executives that had assigned life insurance. There's some kind of spin-off benefit from just a pure life insurance standpoint, and give the credit union liquidity in that underlying asset. So now they can redeem, sell, or convert that cash value into spendable, loanable cash without impacting the executive benefit of the life insurance. And again, some of that dynamic allocation, it was a little less important for this particular client because they're a multi-billion-dollar credit union. They did have a department dedicated to optimizing these things, so they didn't necessarily need the dynamic allocation, but what they gained was liquidity. And this liquidity, or at least nominal liquidity, allowed them to have greater diversification. Now instead of being backed by just we're looking at a handful of carriers, it's now more diversified and it's a higher return. So they end up with a much bigger yield with very little expended effort. This was a very quick, yes, do it and make it happen.
So, Eric, I want to see if I can restate that correctly. What I think here is what you've used the LifeNotes strategy to do in this case is you've sort of broken apart the insurance aspect from the investment aspect of the tools that the credit union has used, and you've given them the ability to kind of keep the insurance if that's appropriate and have the investment still exist, but at a much higher yield.
That's correct. It's one of the curious things about credit unions versus the BOLI world, bank-owned life insurance, which in some ways I think that statement, the reason they're doing it is because their friends are doing it, and the reason they do it really is because banks did it. And the reason banks buy bank-owned life insurance is for tax savings. It's not so much for a yield or a return. It's because they have some very distinct tax advantages. And if you take away those tax advantages and strip that all out, the credit union can still take advantage of stable yields and very secure assets. However, because it doesn't have those features, the cost of the life insurance really becomes a add-on cost that you don't really need to bear as much of that as what many credit unions are bearing. And if you choose not to have that cost, you're essentially going into that strategy that we just talked about where you have an annuity rider, so it has less pure life insurance, so there's less cost. However, the return on that ends up being very low. So what we've done is created a way to take advantage of life insurance returns without having to have a direct impact on the cost of the life insurance, or have, essentially separating those two things, the return on the cash value versus the return on the life insurance. And by separating those and essentially parceling them out in a different way, we've maximized what a credit union can earn.
It's one of those things that kind of gets you thinking in the back of your head. Sounds a little too good to be true. Like there's got to be a catch here, because you're going from, I've got this benefit and it pays this rate of return, and it was sort of semi locked in when he bought it. We all agreed, all right, this is what it's going to be. We're going to have this on our books for the lifetime of the executive in the split dollar case that we haven't got to yet. I recognize that. We sort of agreed to what these terms are. And what I'm hearing you say is that I can sort of redo that and modernize my interest rate based return and also get flexibility. It seems a bit too good to be true to get both of those things without some kind of a cost to the credit union.
There's always trade-offs. A lot of my formal training has been in economics and finance, and the professors are very quickly to remind you there's no such thing as a free lunch. So where does this really come from? And really what you're trading is the potential for a lump sum windfall at death. So if you think about the purchase of credit union owned life insurance, it's the stream of income that you recognize as a result of the increase in cash value, and then a big check at the end. And if we take that big check at the end and say, well, why don't we spread that out differently and spread it out earlier in the program, then you don't end up with that big lump sum at the end, but you end up with more earlier. So that means your net internal rate of return is going to go up because you're getting it earlier. However, there is some that you give up to make that happen. You're giving up some portion of that lump sum amount to spread it out. So it's an explicit trade-off. As I said early on, it's time versus money. Is it more important to have a potential windfall 30 years from now? Or is it more important to have a cash flow stream? And there are very good reasons for having both. There are very good reasons for having credit union-owned life insurance, especially from a key person standpoint. If there's an insurable risk, that's the place for insurance. If you're trying to earn a rate of return, the insurance is just going to be a drag on your return. So we need to do something else with it.
Very, very interesting. And perhaps the biggest takeaway, just thinking about it from a CFO's chair, is choice. The ability to react, to change as the people in the executive suite change, and as credit unions merge, and as interest rates change, to have the ability to react, separate the insurance from the investments, put them together in ways that might make sense for way things are today.
That's correct. I sound like an older person when I think about it, but it's, if there's one thing I've learned, it's that no one's going to predict the future. What we need to have is enough flexibility and enough knowledge and enough wisdom to use the flexibility to maneuver to a changing world. And by giving ourselves those tool sets, we can do this. It will work. It can work. These plans are really, both split dollar plans, credit union owned life insurance, they're very good products. The key to this is making them flexible enough to dynamically adjust to a changing world.
So one final thing, Eric, is, again, you stated earlier that this is the LifeNotes strategy exists independent of any executive benefits system or agent. And those folks that have existing relationships can partner with Stearns to implement the LifeNotes strategy. Who do they reach out to? What's their method of getting in contact there?
Yeah, I say there's always reaching out directly to me on LinkedIn, and or I should point them to Jay Rogers, who did the our initial podcast. He and our associate Jesse Brady are kind of leading the charge on the implementation and operation of that. So reaching out to any of the three of us would be a good first step.
Thank you, Eric. Thank you, Jay. Listeners, be sure to check out part 2 of this interview. In the next part, we talk about use cases for the LifeNotes strategy, focused on the collateral assignment split dollar plan and the impact for those looking for flexibility in that area. That's all the insider credit union knowledge we have for this episode. Are you enjoying the conversation? Be sure to subscribe and share your thoughts with other credit union leaders by leaving us a review. See you next time on See You on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.